Good afternoon, ladies and gentlemen. There's overwhelming number of people here. Let me share today about my own experience about investing in F&B companies. I started doing F&B when I opened my own Japanese restaurant many years ago. But the sad news is it failed because we were way ahead of time. It was actually a Kaizaki style high-end Japanese restaurant. If you know Galleries Hotel, when it first started, the first circular dome, that Japanese restaurant belongs to myself and a partner, but it failed. Okay, but I know nothing about F&B at that time, so I asked my F&B friends. I said, "Hey, how is it like investing in an F&B restaurant?" So they told me that if you do high-end restaurant, 3 years you should take back capital because high-end restaurants takes a fair amount of renovation and investment. So by the third year, in Hokkien I tong for 3 years. Then after 3 years, still not making money. And being a finance person, I decided to follow my friend's advice, and I sold my shares from this Japanese restaurant, and I didn't lose money. So that's a good news. And I started actually after that I started Cyrus Venture Capital, and the whole notion of so I got into F&B pretty much by chance. My partners told me that whatever Eugene tastes and is nice to eat, don't buy, you know. So when we do food tasting, whatever I say is nice, they will do the opposite. So don't listen to me when it comes to taste. But I like F&B because, and I'll share a little bit today why I like F&B. Got into it by chance. I'm a venture capital by background, so invested a lot of internet companies in the 1999, 2000. It crashed, as you know. But if you look at F&B, actually it has grown threefold. The entire F&B industry in the world is gaining a lot of attention, and not just F&B retail, but also agri business. And the total return to shareholders have done better than some of the other industry. And a key trend, this is pretty much my personal view. So if you listen to my partner, don't completely believe in it. But generally, I feel that one, what we are seeing now is a rising consumer consumption in emerging markets. The emerging markets is interesting. I go up to KL for a long time. I haven't been up to KL, but this year I drove up 3 times, and the number of malls that have opened up in KL, it's amazing. I went to Manila. It's amazing. The middle class they are all growing, and they want to go to malls and enjoy F&B restaurants. So when I was KL, I asked my friend, why do people come to KL mall and eat chicken rice when they can go to street stores? And they told me that first, aircon, two, safety. So when they bring the kids to the restaurant in the mall, the kids are safe. If they put the kids with them in a so-called kopitiam, they are worried about the safety of the kids. So there is a rising consumption in emerging markets, and Singapore is right smack in all emerging markets, right? The ASEAN. Secondly, demographic and behavioral change in mature markets. If you go to US, what is interesting now is they are very hot onto superfoods. They are hot on healthy food. They are moving away from fast food. That's why McDonald's have a big headache a few months ago of trying to change their menu. Excuse me. The next trend I see personally is demand for local cuisine. Starting, you see Vietnamese pho doing well. You see even Japanese ramen doing well. You see dim sum doing well. So people are craving for local food, and in the US, one of the best performing listed F&B chain is Chipotle, and it's a Mexican food. Emphasis on value and convenience. Now, people, to some extent, you still have high-end restaurants, people who will spend $500 on sushi, but you are seeing more and more people more discerning, wanting value for money, wanting more comfortable, hip places. That's why in Singapore you see people willing to spend $20, $30, but not the $50, $60. So there is a emphasis on value and convenience. And if you look at it, there's also a shift to online and mobile payments and delivery services, such as all these changes in the way food is being served at the restaurants and even at home. Use of technology in F&B. In the past, I'm vice chair of Japan Foods. We actually changed all our ordering system using iPad, and investment is not small, but we were a bit worried that people, we charge service charge, so we are worried that people would be upset that no one takes their order. But now, there was an incident that the iPad system was off for a few hours. Some people just walk out of the restaurant because they are not used to, they are so used to iPad ordering, and it's fast, okay? There is intense, okay, what's happening now, if you go to any malls, more and more of the landlords are giving up, renting out space for restaurants, if you notice, and there is intense competition and new concepts. There are a lot of young Singaporeans and who are keen to set up a cafe or do some restaurant business, and so we see a lot of competition. Okay, what attracted me to F&B stocks in this part of the world, Singapore and Hong Kong, is I took a study of the US stock market. Some of you, I believe, trade the US stocks. I first look at Starbucks, right? I look at Starbucks and I was amazed that Starbucks, the chart is just one way up, you know. The only time it went down was during the global financial crisis. And when we were involved in investing in Ajisan, and when we listed Ajisan in Hong Kong, the Ajisan China PE at that time was 40 times PE at listing, and 40 times, and guess what? It was the PE of Starbucks when Ajisan China listed. Anybody? 50 over times. Okay, so they were trading like internet stocks, 50 over times. So we have a benchmark that is quite amazing. And when it, I missed the boat because when it crashed down to, we sold out our major stake in Ajisan in 2008, and I had a chance to get into Starbucks in 2009 when it was $10, right? And I missed it. Okay, it went all the way up, and it doesn't seem to be coming down. The payout, if you notice, high growth stocks in the US seems to have zero payout if you buy a asset for probably Apple, but the food stocks always give good payout. McDonald's, another example, went up, and then even with a little of the health food scare, it came down and it went up again. Okay, when it's going to stop or change, reverse, I am not sure. But you notice the payout is 77%. So most of these retail F&B stores, we are very cash rich because we collect cash from you who come and eat our food, and in a way the suppliers who supply us ingredients is usually on credit. So the working capital requirement is actually pretty healthy. This is another one that's amazing. McDonald's spin it off, sold it, but it one way up from IPO, never come off. Recently, it come off a little bit, but it is at Google pricing, right? $671 per share. Amazing, right? Okay, now talk about down to earth. Now come back to the Singapore landscape. So what do we look at? We like companies that are, I think one should look at high gross profit margin business. I always share that if you have high gross profit margin, your business model is extremely secure. Okay, gross profit margin high means your business model is good. Net profit margin high means your management is good, because you know how to count the number of papers your staff took home, or rubber bands. But so you actually try to maintain management costs. We like strong cash flow business, because when the company has strong cash flow, whether the economy goes up or down, we have strong cash flow. In Japan Food, we make sure that we have at least 6 months of cash In the event all our stores have no sales of a SARS, for example, and we have to pay landlord, okay? So with that kind of cash flow, healthy cash flow, we can weather downturns. We like steady and growing dividend payout. I'm sure all of you here, if you are a shareholder of stocks, you like healthy, steady, growing dividend, right? There's one thing in AGM that you never get opposed against giving out dividend to shareholders. Leading market share, I think it's very important to be top of your food segment. The three stocks that I shared in US, Starbucks is number one, McDonald's number one, Chipotle is number one. If you are not number one or number two, you would have a challenge. I will share a little bit. I invested in a Superdog. That's my failure. I invested in Superdog. Any of you have eaten the hot dog in Superdog? It was at Vivo City 313. Okay, you're not the target segment because, but anyway, it failed because the hypothesis was that McDonald's. How many of you have not eaten McDonald's? Okay, so the hypothesis is very simple, very layman. If I can convert 1% of you guys to a healthy, okay, then I ask you, how many of you want a healthy burger or healthy food? All of you, I think, will say yes, right? So if I can convert a McDonald's consuming customer to a healthy fast food choice, the logical answer is yes, at McDonald's price, right? But it failed because of the power of McDonald's in their class in getting retail space, tenant, in their class in getting labor. My staff don't want to work for me; they rather work for McDonald's, right? The tenant doesn't. The landlord wants to charge me high rent, but they are willing to pay low rent for McDonald's, right? Because they are a crowd puller. So it's very important to invest in stocks or F&B stocks that are who are leading in their market share. And most of all, doing F&B, how many of you cook? How many of you cook? Do you complain that no one help you when you cook at home? You know, like everyone just sit down there and eat, and then after that. So doing F&B business is a very, very, very tough business. Very tough. Because you need to deal with food safety, delivery, customer service. So you need to have a focused management, and of course we self-praise a bit, good board, right? You need to have a board who is focused, working with the management. Okay, so these are some companies that we have invested in. We were there before listing, and we haven't sold, personally I haven't sold any shares. If you had invested in Japan Food in 2009, we listed it in the worst time possible, January 2009. It was the second or third catalyst stock listed on the stock exchange. If you had bought the shares at that time and kept it, I think I recognize some of our Japan Food shareholders here, you will have made 18% dividend yield. Okay, you will have gotten 18% a year if you bought it at 20 cents. We have given out 3 bonus shares, and now the adjusted price is 11 cents. Even at current price, I don't know what's the current price, 45 cents, you get a yield of about 3 to 4%. In terms of price, it has gone up about 4 times. Neo, we are also a shareholder there, has gone up about 2.3 times, and the dividend yield is about 8.9%. SKE is our so-called lowest in terms of dividend yield, 3.75. The price of SKE is still below IPO, but we are there for the long term, and it's yielding us good dividend. The challenge in these stocks, you may ask, it's liquidity. It doesn't have a good liquidity as compared to buying Singpost or SMRT. But it is, however, a long-term investment mindset. I mean, if you want to buy today, sell tomorrow, I think you should not touch these shares. Okay, but if you want to grow in terms of dividend, that depends on how the company does and what the board thinks. Okay, just a snapshot of what we do. Some of them are not directly what we own. If you look at actually it looks very nice, right, on this chart. It is by chance. Okay, it wasn't really kind of designed from day one. But we first got involved in Ajisan when there was 60 stores in China. We saw the opportunity to be the next McDonald's in China. We listed in Hong Kong because the owner speaks Cantonese and prefer to be in Hong Kong. Then after that, we got involved in Japan Foods. Then we got involved in Neo, who is doing catering. So we do catering, the largest caterer in Singapore. So number one, we practice what we preach. They are the largest caterer in Singapore. Then we do kitchen equipment fabrication. That means when you want to open a restaurant, you want to call someone to fabricate the kitchen, SKE fabricate for you. Okay? After fabricating, one of the headaches of running a restaurant is the kitchen equipment failure. So SKE has the largest number of technicians, about 70, 24/7, to help you in your restaurant. Then we went up higher, Ongjuju. Ongjuju is directly owned, we have a stake directly in them. They are the largest pork processing firm in Singapore. All your porky in NTUC, all the pork that you eat, majority of it are processed by Ongjuju. Then through Neo recently bought indirectly, Neo recently bought Dodo and CT Vegetable. So those are, we just classify indirectly. In the services business, we used to be a shareholder of Paradise when they were 3 stores, but we recently exited, sold out. Superdog is the one that we invested and failed. It's gone. Then we went to food delivery and other delivery. So Lala Move is a Uber for vans. So if you they want to deliver anything like tingkat or Neo wants to deliver flowers, they can activate the van without owning the van. Within 20 minutes, we guarantee you a van. A bit like Grab Taxi and Uber in Singapore. So if you ever need to deliver flower pots or things to your grandchildren or children, you can download the apps. Okay, why are F&B stocks popular? I think they are attractive play, growing industry, cash flow positive, PE, risk manageable. I think these are all quite clear. But I'd like to highlight this, accessible to retail investors to do simple due diligence. You can go to the restaurant and check. Right? I think I go to Japan Foods at least once a week. So I'm the biggest complainer to Takashi-san, like, oh, this is not good, that's not good. I'm like quality control. So you can go to the restaurant and check out for yourself whether the concept is doing well or not. So it's easy to do your own due diligence. Okay. So what should investors look out for? I think keep a look and an eye out for focused food concept services. It's very important to be focused. Otherwise, you get distracted, and you cannot be good at fast food, and you be good at ramen, and you'll be good at food court. It's a little bit hard. That's my own opinion. You need to favor the number one player. Need to look out for steady growth. You can see from their profit and their revenue. Public companies are less risky than private ones. So if your friends ask you, hey, they are opening a restaurant, ask you to invest, it's a little bit more tricky. It's safer to invest in SGX F&B stocks than private companies' F&B stocks, shares. That's my personal view. What are the risks? Okay, the company can lose focus. After they become successful, they start to do other concepts, they play around with other brands. Failure to reinvent. Okay, consumers now are very demanding. So if you don't innovate your brand, you don't change according to the consumer taste, your brand may fail. The margins dropping due to competition. Okay, so in Singapore, competition, rental and labor are very are rising and real. Difficulty in scaling locally and overseas. You can have a good concept in Singapore, but to convince someone overseas to eat your concept in Malaysia, in Thailand, may be a challenge. So you need to adapt accordingly. Loss of talent. So in Singapore, the number one challenge for companies trying to scale the business is someone you train all the way to general manager, he or she decides that he's going to leave. Okay? And that loss of talent is especially hard for F&B business. Okay, with that, thank you very much for your paying attention. Thank you.